January is finally in the books, and that means we can look at the data together as traders and investors and see what's in store for the rest of February and 2024. What are the big trends for February, and more importantly, what sectors should we look at? Today we talk about the most important charts moving forward and why it's very strange that central bank liquidity has started picking up. And the last time we saw this was near the October lows 2023. So should we be concerned or should we become bullish? Let's look at it together right now. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. Buy the rumor, sell the news? No. Buy the rumor, buy the news, buy the dip, especially in technology. I mean, the big names, Nvidia, Microsoft, Apple, Amazon, Tesla, Google, Meta, all green. And when they're green and the rest of the market is green, you just get like huge amounts of breadth in the market and just a rally. You get like a very strong rally. However, there was weakness in certain sectors. Look at financials, banks, capital markets, regionals. We're going to talk about them, as well as energy. But other than that, it was just buy the dip. I mean, defensive, cyclicals, sensitive sectors. Look at utilities, look at materials. Almost every sector was up on the day. But let's look at some breadth. And 400 winners in the S&P 500, 102 losers. Great breadth buying across the board, especially in the big names. There were quite a number of losers right here too, but overall a very, very bullish day across the board. But look at the majors. The RSP, IWM were trending lower, sort of around this 11:30 area. And we know what happened right here. We had a 4 to 8 week bond auction, very well received, and then markets absolutely rallied. Now at the same time, bonds didn't do much. That's because yields actually took a huge dump yesterday. But after the bond auction, after we got some of the news, the productivity data points, the markets absolutely rallied. And I think this is going to continue in tomorrow with some of the data points we received from some of the big names. So January just concluded, guys, and let's have a look at some of the data. So an up January is very bullish for presidential election years. January has been a weaker month in year 4 normally, which makes January's 1.6 rally noteworthy. When the S&P 500 is up January year 4, the index has been up 100% of the time, 11 out of 11. And for both the years, the rest of the year average returns was 16.6 and 12% respectively. This suggests SPX at 45.25 to 550 at the end of the year. The SPX average annual return February to December year 4 is 7.5 and 7.2% respectively, which equates to an S&P 500 5120 and 5190 respectively. Now they put these two figures in order. So this is 2024 and this is presidential election year. Now January barometer with presidential cycle. So we can see it right here. We go to year 4, we go January up, the year's positive 11 from 11, average annual return 16.5%. But if January is down, it's actually such a different story. So the fact that January was up is very, very huge for the index, and it probably means higher price action because January sets the tone for the rest of the year. Now we got the latest sentiment survey, a huge uptick in bulls, 49.1%, up nearly 10% from the week prior. We also saw a decrease in bears and a decrease in neutral. A lot of people flipping to the bull side. A lot of people were buying the dip. Now looking at the NAM exposure, active fund managers and their exposure to US equities, so pretty much the S&P 500. And you can see this is sitting at 84.13%. It was at 80% last week as well. Now, besides equities, what is the likely allocation for bonds and cash? Well, according to Wall Street, the average recommended allocation by Wall Street strategists is about 32% for bonds and continues to remain elevated, especially as bonds have become increasingly cheaper since 2021, 2022. Very much the same thing for cash. Wall Street analysts have increasingly said as rates have come down to hold less cash. We have seen a slight uptick though. That being said, still remaining at historically low levels. But let's talk about sectors for the day. So we know that right here around 11:30, we had that strong bond auction, markets rally, particularly regional banks. But the best performing sector, you think it'd be technology, semiconductors, not the case. GDX, home construction, staples. I think a lot of that had to do with what's happening at Walgreens. You know, especially they said they were expanding quite a number of stores. Maybe that's saying consumer demand is still there. But other than that, we look at all of these and what are the best performing sectors right here? Utilities, real estate, discretionary, staples, home construction, GDX. These are very sensitive to rates. Maybe not so much like discretionary, but definitely very sensitive sectors. One thing I also want to note, industrials flying under the radar. Now, a lot of the strength in industrials has been marked by Boeing and the aerospace industry. They've had a rough time of it, but manufacturing is sort of bottoming out, coming out of a recession. recession that it's been in for the better part of 12 to 18 months, and we're seeing continued strength in industrials. I mean, you exclude Boeing, it might actually be one of the best performing sectors for January. That being said, software continues to outperform the SPY. There's definitely something going on with software right there. I think a lot of the bigger names, technology, semiconductors, those AI plays, a lot of people are holding a lot of those stocks, and they're looking at other areas, stuff like software, especially IGV. This is an expanded software ETF. So it looks at more smaller cap, mid cap names. And that's why we're seeing software, continually outperform the SPY. You go look at the last 5 days, one of the best performing sectors, IGV, expanded software. But we also got the latest GDP Now data from the Atlanta Fed. It actually ticked up from 3% to 4%. And so the Fed must be seeing something in their data, maybe construction spend, maybe some of the CHIPS Act and IRA, maybe the last money of the Inflation Reduction Act and the CHIPS Act is starting to kick into the economy, and that's why that's ticking up. I have no idea why, but as it stands right now, it's actually above 4%. It's at about 4.2, 4.3%. The economy roaring on all four cylinders. At the same time, wage growth. This is the Goldman Sachs wage tracker year over year, quarter over quarter, and then compensation per hour. And we're sort of seeing compensation tick up. So people are getting paid more at the same time, while wages are sort of like flatlining, you could say, coming down a little bit. And we're going to talk about some of the labor data we got today. At the same time, excess savings were about 800 billion in December. They are coming down significantly. Listen, it took 2 years to go from here to here. It's probably going to take another 2 years to go from here to zero. And a lot of people see this as a negative thing. I see this as actually quite bullish, having excess savings work into the economy, buying assets, buying whatever people need. And this is excess savings. Once this is drained, people just got their normal savings as well. Now, let's actually talk about manufacturing. So this is the ISM numbers. So new orders actually increased quite significantly. A lot of people were upbeat on the news. That's why industrials rallied today. But overall, if you actually have a look at all of the ISM data that came in slight contraction, ever so slightly, but you can definitely see a bottoming out situation here for manufacturing as a whole. We're definitely coming out of this recession, and new orders was a huge tailwind for manufacturing, industrials as a whole, and industrial proxy stocks. At the same time, US non-farm productivity quarter over quarter, and we're actually in the midst of a productivity boom. Look at these numbers. I mean, very solid numbers, rarely missing. When it did miss, only by 0.2% in comparison. That's still growth in productivity as a whole, coming off the previous number of negative 1.2%. And we're in the midst of a productivity boom. We're smashing these numbers, and manufacturing is definitely coming out of recession. And here's the thing. Normally when we get a recession, like, all industries are impacted at exactly the same time. But in this instance, after the COVID situation, I believe the reason why we didn't get a recession as a whole is because different industries went into a recession at different times. At the same time, corporates held on to labor after COVID, and that's why the economy for the most part has remained incredibly resilient, as well as the consumer has held in there. While manufacturing is coming out of this recession, I do think the next sector we're going to see a recession in is commercial real estate. I think that's going to materialize in the next 12 months, but that'll be offset by manufacturing. That will be offset by, the consumer remaining strong, stronger labor market, government spending. It's an election year, rates coming down. So all of these moving parts are happening at different times, whereas in a recession, it happens all at the same time. I think that's the main difference. That being said, initial jobless claims and continuing claims did tick up quite substantially. When you look at it as a whole, continuing claims did get to just under 1,900. I actually thought that was what's going to happen last week with seasonal adjustments through from November, December, the Christmas period. And I think this actually came slightly above, as well as initial jobless claims. So the jobs data did miss ever so slightly, but overall still secularly tight employment as a whole. And if we actually have a look at layoff rates, they have fallen and are somewhat below pre-pandemic levels. You can see employee layoffs monthly rate and the Goldman Sachs tracker, and sort of below pre-pandemic levels. And again, this just supports the fact that the labor market is extremely tight right now. Then we also go have a look at job openings. They've trended lower, but somewhat elevated. And you can see the most openings coming from education services, healthcare, transportation, federal government. Where are we losing jobs? Information, retail. So like technology, this is where job openings are the least. And we've seen a ton of layoffs, especially in the tech sector. Now, looking at alternative employment indicators, very mixed. So the consensus was 1.8, but then we have a look at like the Goldman Sachs layoff tracker, 250K, the Census Business Pulse, 265. Then we look at ADP. And I think what we're seeing here is like this kind of tracks like everything as best it can. This kind of tracks like smaller employments, like 30 to 50 people employed in these areas, something like that. We're seeing these bigger businesses who held on to employees after the pandemic, sort of just laying off the excess which is coming into the market. And that's why employment has remained secularly tight. But that being said, job openings did increase in the jobs report we got this week, and I do think those people are going to be able to find work. All in all, as long as there's job openings, people will eventually find work, and that's going to keep the labor market quite tight as a whole. But we're going to definitely keep an eye on employment figures. Now let's look at some seasonal data here. So this is February to December S&P 500 performance after a 10% plus rally from November to January. And you can see that on average, 12 months later, the return is 14.1%. 13 up years, 1 down year. The only down year, 1986, and it was actually positive in the first half, and it was only a very bad month in October 1987. And if we actually have a look at the specifics right here, 21.8% down in October. This was the flash crash of 1987, what they call it, Black Monday, I think, and then a terrible November the following month. So this was the one outlier to consider. That being said, in every other instance, it was very, very positive. And you actually have a look at max drawdown. Let's exclude this one. All of these drawdowns are just buying opportunities for a huge rally that comes 23%, 21%, 25%, 14.8%. Very, very bullish stats based on everything we're seeing right now. Momentum is on the side of the bears. Now let's talk about earnings. So we got Apple, Amazon, Meta. We're going to talk about them. Apple, you know what? I didn't think it was great earnings, but it wasn't bad. They beat on revenues, beat on EPS. What the market didn't like about it though was services. This was really the growing segment of Apple that was really going to propel them forward. They just missed, as well as China revenues. Missed by a substantial margin, 11.2% downward growth. But the fact that revenues grew, I think that is really going to help the stock find support. Not a bad quarter from Apple, not a good quarter either. You know, for a stock that makes $480 billion in revenue, to actually see this type of growth, I guess it's all right. Now let's talk about Amazon. Amazon beat everywhere except AWS. It was a slight miss, and I think some of this had to do with currency conversion. Beats everywhere else though. They released some AI, I can't remember the name, that's gonna help advertising and shopping, and that's why the stock was up like 7% in after hours. Overall, a great quarter from Amazon. I think this was really, really good, and this is what Amazon investors wanted to see. They needed this type of quarter because Amazon was priced to perfection. One of the most expensive Mag 7 names, or Significant 6 as they're now calling it. But let's talk about Meta. I own Meta. I woke up to my position being up like 15% plus. Great quarter. Beat on revenue, beat on EPS, beats everywhere, beat guidance as well. The street really liked that. $50 billion in share buybacks, a 50-cent dividend as well, and that's going to increase. And you know what? You know why Meta was up like 15%? Now that Meta's introducing a dividend, a lot of these like income funds, these dividend investors can look at Meta, get into Meta, and I do think there's still some great growth ahead for Meta, and still trading at like a 1.1 PEG ratio. I need to go compute the stats, but yeah, still a pretty cheap stock, one of the cheapest stocks in the Mag 7 or Significant 6. Great quarter from Meta. My biggest holding literally went from like 87K in my portfolio to like $350,000 plus. Just insane. Now here are the latest earnings stats. I gave this to you guys yesterday. The Q4 earnings reported so far are negative 5% below expectations, entirely due to financials. The surprise was a positive 5.3%, but I'm willing to bet after Meta, Amazon, and Apple's earnings, which by the way were surprises, they were beats on both revenues and EPS, probably going to see this increase even more. And you know what? That's most of the Mag 7 names reported earnings. Sure, Tesla bombed, but everything else was a beat. Every other company was a beat. Microsoft beat on revenues, EPS. Google beat. Amazon beat. Meta beat. Apple beat. It's literally up to Nvidia right now. And I think Nvidia is going to beat on the quarter based on what SMCI did. I mean, it might not get the reaction that Meta did on the day, but Nvidia is, I think, going to produce earnings in line or above. Now, let's have a look at some data. Now, this is for the next 2 weeks, right, guys? A trade that you guys could actually be taking, especially if you bought the dip yesterday. This would be a risk-free trade. Essentially, the S&P 500 performance from January 27th to Feb 15th, when the trailing quarter, October 27th to January 27th, is 5% or more. On average, we return 2.3% and 21 up years, 5 down years. More stats in favor of the bulls. Let's actually have a look at seasonality. Now, I know we just printed a plus 1.25% for the S&P 500, and you'd be looking at this and going, well, we just absolutely crushed February seasonality in one day. Yes, you're right, but the number actually doesn't matter more than the direction and the trend. And normally what we see at the very start of February is a huge push up. That's exactly what we saw today. Maybe we see continuation in the second day, maybe not as much as today, and then we normally get like trepid action and then a pullback, maybe even to as low as this. So So don't worry about what these numbers show. Look at the overall direction. So we're sort of we're following seasonality as always, which is moving up. Then we might consolidate, move up a bit further. And then after OPEX, we might actually look for sales further into the March OPEX. But that being said, with how earnings are looking right now, with what the market's doing, with what the data's pointing, everything is looking really, really positive. The economy is in really, really good nick. And even if the labor market does cool off a bit, that actually might be bullish because wage inflation might come down. And that's something the Fed is trying to battle. Now let's have a look at some gamma, guys. And okay, we did see a lot of negative gamma come into the tape. That all of that might be removed tomorrow with the positivity we saw. We're still at the 5,000 strike being the largest strike, still a lot building at 5,100. Something to note that the gamma flip zone has moved up as well, but all in all, we're still well in a positive gamma environment. So still buy dips, sell rips, especially above the 48.65 level. Now, guys, starting from tomorrow, actually starting from today, I would say, but I think according to Kem Carson, starting from tomorrow, Vanna and Charm are going to have an effect on the market, and that's going to further exacerbate dealers buying dips, selling rips, and the positive gamma environment. Get into the first week where we see Vanna and Charm come back, and then they're the strongest during the second week into OPEX. This right here coincides with the seasonality I showed you guys in February, which looks something like this, right? This OPEX weeks coincides with that drop, and then we actually have the window of weakness. So seasonality and options flow are sort of all aligning. But that being said, we're going to react, not predict what the market comes and shows us. Now, let's actually have a look at some charts. And looking at the S&P 500 chart, bullish. This is particularly bullish, especially up here. If we actually look at what the day looked like specifically, right? We had this run up, just kind of looking weak. Then we had this huge day, this gap down after Powell spoke, the FOMC. Then we actually didn't break the close or the low of yesterday. We gapped up and moved all the way up above yesterday's open and in line with the high of yesterday. If we do get follow through, close this gap, that's probably going to be a bullish sign to go all the way to 5,000. But, based on this, bears had the opportunity to take us lower all the way to 49.71 after this candle. They did not. And with earnings coming in the way it did, especially when you have a look at what Apple did, Meta did, Amazon, and then you have a look at some of the other stocks we're seeing, right? I'm talking about MasterCard. I'm talking about SMCI, some of the semi names, some of the industrial names, and the S&P 500 trading at this level. If earnings continue to go the way they are, the S&P 500 actually gets cheaper at this level. Now we're going to have a look at one more chart. This is the Nasdaq. Very, very strong nonetheless. Again, still no technical damage in this chart. For there to actually be proper technical damage, what would need to happen is either this right here or this right here would need to have a weekly close or even maybe a monthly close below these levels. That would be technical damage. As it stands right now, this is still a very, very healthy pullback. If we actually zoom in, the S&P 500 does look stronger, but it's the same thing with the Nasdaq. As earnings comes in, this right here, the Nasdaq actually gets cheaper, especially as we get good earnings. 6 of the 7 Magnificent 7 have reported earnings. Of those 6, 5 have beaten revenue and EPS. 3 of them have raised guidance. Tesla was the only miss. It has its own issues when we're still yet to see Nvidia, and we're expecting a blockbuster quarter from Nvidia. Although the Nasdaq does look a lot weaker than the S&P 500, and that's because we're seeing strength in names like utilities, energy, healthcare, industrials. The Nasdaq 100 doesn't have these names in them. But in the data in the week ahead, we got one more day of trade. We got non-farms. That's the big one. We have non-farms tomorrow. We're going to see what those payroll numbers are. We spoke a lot about employment data today. Everything comes down to what non-farms do tomorrow, and we're going to cover non-farms as a whole. But if you've made it up until here, guys, thank you so much for watching. If you like this video, guys, please subscribe. Hit the like button. It really helps me out with the algo. Hit that notification bell too. Cheers.